Today's topic is futures contract. A futures contract is a legal agreement between two parties, which are the buyer and the seller, about an asset which they anticipate to purchase or make a sale at a specific price and on a certain date. The assets which use future contracts are commodities, indices, and currencies. Therefore, there is a wide array of products which can be traded using a future contract. Future contracts allow traders to make sales and purchases whenever the market is open. Therefore, they do not have strict restrictions imposed on them like in the case with the stock market. A futures contract can be traded by a number of traders. It is open to day traders and longer-term traders. Likewise, non-traders who are interested in the specific asset can also trade using a futures contract. What are the most common futures markets and their symbols? The symbols used for futures contract are majorly traded at the CME, and they are represented by a number or a letter or both. The letter in the symbol stands for the month in which the contract is expected to expire. The number in the symbol represents the year in which the contract is expected to expire. Index features. ES. It is known as the E-mini S&P 500. It is majorly traded on the CME. YM. This is known as the E-mini Dow Jones Industrial Average. It is also known to be traded at the CME. Currency features. 6E. This is the Euro to US dollar, also traded at the CME. 6B. This is the symbol for the British pound to US dollar, and it is traded on the CME too. Commodity related futures. GC. This is the symbol for the 100 troy ounce gold. SI. This is the symbol for the 5000 ounce silver. CL. This is the symbol for the 1000 barrel crude oil. So, are there different kinds of futures contract? Yes, there are two kinds of a future contract, the hedgers and the speculators. The hedgers have the aim of making their duties in their businesses stable, but they do not focus on the profits or the losses they make. Speculators gamble on the future prices of a specific asset in the future. Why are futures contract important? They are a zero-sum game. Therefore, if one person loses a certain amount of money, the other one gains the same amount of money. Traders are accorded with an amazing quantity of leverage where they can trade many contracts using the little money that they have. Future contracts should be settled daily. This means that if the person holding the contract fails to settle the money on a given day, they are still held liable for that day and the settlement is carried forward. Are future contracts risky? Yes, they are. The prices for futures contracts trading for a certain asset are quite unpredictable. This risks the contract holder to loss of their money if the market price fluctuates within the period of the contract. Let us look at an example of a futures contract. If a producer of oil has plans to sell a certain number of barrels of oil in the coming year, it should be delivered within 12 months. If the market price of one barrel is rupees 100, the oil producer may decide to have a futures contract to buy or sell the oil at the same amount. This will benefit them if the market price fluctuates. Well, that's all for today. In the next topic, we will learn about payoffs and margins.